Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A episode. As you can tell from at least listening to me over the last week or so, my voice is certainly recovering, so I appreciate that. Okay, all good. Let's get into it. So Julianne asks, yet again, another excellent episode. Episode 370, Julie was kindly referring to back in August, 20th of August, or sometime in August anyway. What does long-term property data tell you? And in that episode, I put together, past performance over 1, 3, 5, 10, 20, 30, and 40 years, because quite often the thesis behind the episode was like there's a lot of talk around short-term property price changes. What has happened over the last 12 months, even the last month, last quarter, all these sorts of things. But I think we're, as investors, much better to zoom out, I should say, maybe not zone out, zoom out and look at the longer term data. Then let that help us inform, some decision making in terms of which market we think is the best market to invest in. So episode 370, if you missed that, you can obviously go back and have a listen to that one. Anyway, Julianne's asking, I wonder if you had any comments regarding the Canberra property market. It's a really interesting market because if you look at population size, Canberra's got less than 500,000 people, which, obviously smaller than Adelaide, Perth, obviously Melbourne, Sydney, Brisbane, of course. I'm not sure population of Hobart's probably similar size, I would imagine. Anyway, so population size, it's not that great, but of course, no surprises for guessing where the most of the demand comes from in Canberra, which is obviously the public service, and that has tended to underpin performance. And so when you have a look at the growth really between the start of 1980 through to March 25, so I've updated these figures for June 25, the capital growth rate, average capital growth rate over that time is 7.36%, which compares favourably to both Brisbane and Sydney. Sydney's 7.51%, Brisbane is 7.54%, obviously because of the most recent period of growth, and Melbourne over the same period of time, 7.17%, obviously not a bit behind because obviously the last decade of lost performance really. So you go, okay, you draw a conclusion from that, go, okay, well, Canberra's pretty good. It's a good investment proposition, except that Canberra can go through prolonged periods of very little growth. So the 18-year period beginning at the end of 02 through to the end of 19 was 3.9% growth. So that's not a lot of growth. If we think over that time, inflation might have been 3%. So it's only really 1% real growth. That's a terrible outcome over an 18-year period. Between the end of 19 and the end of 22, you've got 12.4% growth. That's during that sort of COVID period, if you like. And prices have come off a little bit really since the end of 22. So no real growth again. So we've seen that market does go through shortish periods of growth. I mean, you can go back to really 1980 to 92 is 11.6% growth, although in the 80s there was some strong growth really in almost all markets, and you could argue not really that comparable to the 80s anymore. So look, I think on average, it's done okay. It has had periods of maybe more prolonged periods of growth, no growth, so flat cycles, extended flat cycles. So you just want to time, your entry into that market. And given that if you look on a 45-year period, that Canberra is second only to Sydney and Brisbane, you might draw a conclusion to say, look, in the cycle, maybe not the right time. The right time was probably just pre-COVID to buy into Canberra. So I'd just be really conscious about the cycles in Canberra. And the reason for that is because it doesn't really have a lot of multifaceted demand. Whereas you look at particularly Sydney and Melbourne, and I made this point before, by the way, they've got a lot of industries that are driving demand in both those states. There's not one particular industry that's really standing out. They've all got head offices of ASX 200, even ASX top 20 companies. There's a lot of well-paying jobs in Melbourne and Sydney, to a lesser extent Brisbane. Over the period of time I've had clients that, C-suite clients that are, looking for executive roles. They're few and far between in Brisbane. The reality is most of them in Melbourne and Sydney. So, you've got one sort of major component of demand there in Canberra. So you just want to be really careful about the timing. Obviously, asset selection is critical as well. And, just really thinking about those cycles. But if you're going to invest in Canberra, because historically we can see we've got quite short growth cycles and potentially quite long flat cycles, you really need to approach Canberra perhaps with a much longer time horizon. So, in Melbourne, Sydney and Brisbane, it's possible if you time the market right, you can get in and out of that market within a 10-year period and do pretty well. I think that's more difficult to do potentially in Canberra. So that's the only sort of proviso there. We don't really recommend buying in Canberra unless the clients are buying a home, primary place of residence, so something to live in. But if it's just pure investment, I reckon you're better off going outside of Canberra for that multifaceted demand. Anyway, thanks, Julie, and hopefully that helps in terms of frame what I think about Canberra. Okay, next question is from Shelly. First of all, I'd like to thank you for the excellent podcast. All the information you share is very useful, and I'm sure it's helping many people to create wealth. Thanks so much, Shelly. We're a couple in our mid-50s with a 14-year-old child. We have combined family income of $380,000. Home is worth 1.4 with 237,000 of debt. Investment property bought in a discretionary trust. Property is worth 680. Bought for 680, now valued at 820 with a mortgage of 714. So investment property, family trust, not a lot of equity in it. Combined super of 764,000, saving about $3,000 a month after super contributions. We're primarily focused on repaying the home loan as much as possible and maximising non-concessional contributions. We're hoping to retire at age 60. Remember, they're mid-50s, about 5 years' time. However, we've realised it's probably not possible, mainly due to the high cost of the investment property. By 2038, they think it's going to cost about $34,000, which includes principal, interest, loan repayments. So we're considering what options are available in order for us to reduce the debt and hopefully retire with an investment property that is neutrally or as close to neutrally geared as possible. And these options include subdividing, building at the rear and keeping, selling one and keeping the new property, subdividing and just selling the block of land off at the back, or any other options. We'll lean towards this second option, which is selling the land at the back, but we'd have to pay capital gains tax. So would it be worth waiting until retirement? Could you please give us your opinion? What would you do? By the way, would it be possible to produce a podcast on the important steps that you need to take in the lead into retirement? Thanks very much for your help. So, Shelly, that's a really good idea for a podcast topic. And that's really the most challenging part of doing this podcast, is coming up with the ideas and the topics. So, for all the listeners out there, well, I certainly get lots of questions, and keep submitting them. Questions@investopoly.com.au is the email address. But if you do have suggestions for podcast topics, I can't promise to always adopt the suggestion. It's got to be something that, I feel is going to suit the audience and that I enjoy writing about, of course. But if you do have any ideas, please send them through. Okay, look, Shelly brings up a really important point here within her question. She probably doesn't realize it, is that, it's one of the main sins that I think, or things that people get wrong, if you like. Probably shouldn't call it a sin really per se, but it's the reason why I wrote Investopoly, the book. And of course, the podcast is named after the book, but is that I thought people were going about financial decision making in the completely wrong way. And so what Shelly's, and maybe it's not a perfect criticism of Shelly because it's a good question, so I'm not having got the question. But in this situation, the way I kind of read the question is we're potentially trying to fit a square peg in a round hole. Like, should we really be, property is a good asset to use to build wealth, but it's not a good asset in all situations. So sometimes what we find is that because people are already invested in property, then they're so attached to it. I don't want to sell it. I still want it to work. How's it work in my retirement? Whereas I think you're better off starting with a clean sheet of paper. And how a property's cash flow behaved is a function of how it's funded and financed. It's not really also just the property itself. So to then react and say, well, I want this thing to be positive cash flow. So now I'm going to put more money into the property. So I'm either going to subdivide and build or subdivide and sell. But really, the consequence of doing that is that you're changing the very nature of the asset that you bought originally, which hopefully, if you listen, I don't know the property. Shelly hasn't shared the address or anything like that. But the idea around property is you buy something that is predominantly land, and land appreciates and compounds over time. And then that's how that compounding capital growth is really how you build wealth through property. Now, if I go and change the nature of the asset, like develop it and increase the amount of improvements on that property, then I'm changing the nature of the asset, and that's not actually going to work out well. So I would argue in Shelly's situation, the question she should be asking is, what do I do with this property over the next 10 years so I build the most amount of wealth? And I use a 10-year time horizon just because it's kind of easier to think in sort of 10-year blocks. But really, what can I do with this property over the next period of time so that I'm financially stronger in 10, 20, 30 years from now? That's the key question. Don't worry about the cash flow. That's kind of a subset of the question. And so I'm not criticizing Shelly necessarily, but because this is what she might be thinking. But I just want to make sure that people, when they think about these sort of property decisions, it's not just how do I solve the cash flow problem. You should be really asking is, how do I build wealth, and is this property going to be the right asset for me longer term? So I wouldn't do any of those things in terms of subdivide, all those sorts of things. Look, in your situation, Shelley, and just as a reminder, her home loan's 237,000 compared to a home about 1.5 mil. So and mid-50s and family income of 380. So we're not really that worried about the home loan as far as I'm concerned. They're going to repay the home loan. It'll be gone. So it's not a major priority. I mean, it's a priority in so much as that I'd like it to be zero within the next 5 years, but it's not a key success factor. Your property is on principal interest repayments. I get that onto interest only. I'm not interested in, excuse the pun, interested in repaying the principal, the loan principal. That property should hopefully work by itself in terms of capital growth. You said you bought it in 23 for 680 and it's 820. Now, of course, a couple of weeks ago, I spoke about last 5 years of data and we can't extrapolate that, but let's hope it continues to grow in that fashion. If it does, then your investment success isn't really linked to your ability to repay that loan. So that is principal interest repayments. And really the property's cash flow is only really a function of, how much gearing you have against the property. So I think I'd switch it to interest only. I would then put all my surplus cash into the home loan. And then after I've finished that, I'd put all the surplus cash into the investment property offset. And I would just do some numbers around that to see how far that went, how far that got you. And then in 5 years' time, you might then start thinking about potentially selling that property. Now, you might say, well, in 5 years' time, if on interest-only repayments, it's only costing you, say, $10,000 a year after tax or something like that. I'm just going to use that as a figure. You might say, well, I'll hold that 3 years into retirement, which means that I need to put another 30,000, so 3 times 10,000 into that property towards its holding costs. I'll need to take that out of super. But you might decide it's just better to hold that property for a little bit longer to get some more growth out of it. And then you'd sell the property, you take those proceeds and you put it all into super. I think that's a much better solution than potentially subdividing and taking an asset that what you're really doing is selling off the best part of it, which is the underlying land, and you're keeping the dwelling on it, which is the improvements, which you're not going to get a lot of capital growth from. And so I think by changing that asset, it's actually probably going to have a negative impact on the investment returns of that asset. And so sure, you get to hold on to the property, but I'm not sure holding on to a property like that's really going to do much for you. And in this case, I think it's a case of divesting of the property. It's just really around timing when you do that, whether you do that at 60 or at 63 or 65, whatever it might be. And the answer to that question might be, what is the impact of how much surplus cash flow can you get into that offset account between now and age 60 in order to minimize its cash flow cost? You might even toy with the idea of, as I said, using super to pay for some of that negative cash flow just so you can hold on to that property for longer. But you'd want to be certain that you're going to get rewarded for the capital growth in the longer run. Just a word of warning, because I met some prospective clients this afternoon that also had property in a discretionary trust. Just be really careful about property in discretionary trust. Typically, the negative cash flow is trapped inside the trust. The negative cash flow, so the negative gearing, I should say, the tax benefit at negative cash flow is incredibly important longer term because it defrays the holding costs, which means you need to put less in or contribute less cash flow towards holding that property. And that's an important consideration because in, for example, Shelly's situation, it just means that she's got more. If you minimize the cash flow, she's got more to put elsewhere. So either in the offset account, in super, or whatever it might be. So the cash flow is not as good, or tax benefits aren't as good, the immediate tax benefits. And then land tax, quite often, almost always in different states, you're going to pay more land tax inside a trust. So I almost never recommend putting property in a family trust. Very limited circumstances I'd do that. So if you get that advice, please do a little bit of deeper digging and get a second opinion, because once you put a property in an ownership structure, it's very difficult to change it. Like, it give rise to stamp duty and capital gains tax consequences. So it's cost prohibitive, and just be careful around that. The client that I just spoke to this afternoon regretted the fact that they got that advice, and it's just, there's so much good quality data and information available on the internet these days. It's easy to avoid that mistake, I think. Anyway, Shelly, thanks for your question. And it was a good one because, I think it does remind us of being really strategic about our approach to asset allocation. Thanks also for the podcast idea. Okay, next question is from Bay. Thank you for all the effort you put into sharing such great information in your podcast. I had a question about super allocation I'd love to get your thoughts on. I'm 43 years old with 465,000 in super, and my wife is 44 with 265,000. We're planning on contributing the maximum 30,000 per year. Intend to sell a non-investment grade property next year or so and use that to contribute into super. At the moment, my allocation is 54% in international shares unhedged, 23% international hedged, and 23% in the Australian share market. My partner's asset allocation is 100% international shares unhedged index. All the current and future contributions are directed to international shares unhedged, which has an expense ratio of 0.08%, so 8 basis points. As you know, international index funds are heavily weighted towards the US market, which is all-time highs. I've heard you mention that once your super balance reaches a certain level, it'd be worth considering active management. ART, Australian Retirement Trust Active High Growth Option, has an expense ratio of 0.7%. My question is, would the higher fee be justified for our combined balances, or would you be better off staying in an index fund till around 55 and then gradually move to a more conservative option? Okay, it's an excellent question, Bay, and let me try and unpack it for, everyone that's listening, including kind of recapping over what I was really talking about previously. So a lot of these very low cost index options seem very attractive. And when you look at past performance, they're very, very attractive, but you've got to be really careful about returns chasing. That is, being too focused on returns and not enough focus on risk, because risk by definition is the probability or likelihood of you not achieving your benchmark return or your desired return. So if I go into a product and it's returned 10% for the last 10 years, then I'm in love with that idea of getting 10% over the next 10 years. Now, what is the probability of me earning 10% over the next 10 years? And that's what we talk about, the risk in the portfolio. So if it was guaranteed, then I'm all in. But if because of the way it's been investing or it is invested, the probability is much lower, then actually I need to really think carefully about whether that investment option is attractive to me. And so that's why risk and return are incredibly important, regardless of your risk profile and regardless of your stage of life. I think that there's still risk and return really, really important. So we know then that these low-cost options just track an index, the market cap index, are very easy and cost-effective to track that. And we know that, the problem with the market cap index is that about 74-ish% is invested in the S&P 500 in the US market. And we know that there's never been more concentration in the US market than ever before. Nvidia, for example, is more than 8% of the market. The top three stocks are about 20%, I think. And the Magnificent Seven now about a third of the index. So the problem is now when you're tracking a market cap index is a lot of your portfolio is actually invested in just a handful of stocks. And those handful of stocks have driven or given the returns or contributed to most of the returns over the last 10 years. So are you comfortable doing that? Because essentially you're now a growth investor because they're all growth stocks. And to what extent will that run continue? The really interesting thing is that revenue and earnings, so the fundamentals in a lot of those stocks are very, very strong. When you look at the profit and cash flow and revenue 10 years ago compared to today, you go, well, the companies are growing at an amazing pace. Nvidia, for example, I mean, it's a cash cow. But, everything's popular until it's not. No stock can stay at the top forever. When you look at the top 10 stocks globally by decade, they change a lot. So when we're looking or taking an evidence-based approach, you would go, that's risky, because we're in uncharted territory in terms of the concentration in the US market at the moment. So, one option's going to cost you 0.08%. The other option's going to cost you 0.7%. So let's call it almost, I don't do the maths in my head, 10 times the amount. Whereas if you go to a standard premixed option, like a standard growth option, they're going to include some indexing in that, but they're also going to have investment managers that use active funds management. And they're going to be thinking also, because they don't have to blindly follow an index, they're also going to be thinking about these risks that I speak about. So at what point is it worth paying those extra fees? So about 0.6%. Well, it just depends on your balance. If you've only got 50,000 invested in superannuation, then whether you get a 6% return or a 10% return is not really going to change your balance very much. It's going to what's really going to be most important are the fees and your contributions. But as you get closer to $500,000, returns start to do virtually all the heavy lifting. Contributions are important, fees start to become less important. So since we know that fees are less important and contributions are less important than returns when you're approaching $500,000, then I'd be inclined to either do one of two things: move my entire balance to a actively managed balance. Now, the difficult thing with this is because, and I've spoken about this before, there's not a lot of transparency in how the super funds manage your money, like in terms of portfolio characteristics. And, whilst most members won't understand all that information, they really should publish it so advisors like me can look at it and talk about it in podcasts and those sorts of things. So we're taking a bit of a stab in the dark here when it comes to industry super funds, but you would hope they're thinking about these concentration risks. So either move your fund into something like that. And when you look at the fees for managing super for high growth, Australian super charges 0.53%. So you're only going to pay maybe an extra sort of 40-ish points for active management. I think I would do that every day of the week, given where the concentration risk is. I really would, given that I'd feel a little bit safer knowing that I'm not just putting all my eggs in that particular growth basket. If you didn't like that idea and you really were super focused on fees, and I think you can become too focused on fees, by the way. I don't want to be, silly about it, but I mean, because fees are important, but sometimes I think you can become too focused because returns are important too. So if you didn't like that idea, I'd go 50-50. So, for Bay said he's got 460,000. Well, maybe put 250,000 in Australian super high growth and leave the rest where you are, for example, and you kind of hedge your bets. The only downside to that is you're going to pay 2 admin fees, but we're only talking about $100 a year. So it's not really going to move the dial. It's not going to change the outcome. Or what you could do is say you put all your super with Aussie Super and then leave your wife's super with ART in an index fund option. At least at your family level, you're kind of hedging your bets or having an each way option on it. But I think probably, if I'm going to be really honest, I think probably irrespective of the balance, I probably wouldn't be in all market cap indexing at the moment with my super. And, I'd probably prefer to pay 0.5% than 0.08% to minimize that risk, almost irrespective of my super balance. But, that's just me. And look, I think that mean reversion story will play out, but I'm not saying that technology's dead or that technology won't generate a lot of the returns moving forward. The big question is, will those magnificent seven, will they still be at the top or still have the same dominance of the market in the next 10 years? Could do, but I think it's pretty risky. And actually, by the way, this year, we've seen a lot of the returns come from the ex-US market. So the US market's still done okay, but Europe and UK and Japan, and particularly emerging markets, have driven much higher returns this calendar year, by the way. So, that's already playing out. Just another reason, I think, to look for more active management inside my super. I don't want to flog a dead horse here, but of course, a better, although you might need to pay for advice, which you need to factor in, and I don't think it's worth doing that just for those super balances if there's nothing else to help you with. But a wrap platform helps an advisor put a asset allocation together that is completely low cost and transparent, that helps you achieve that end game, and that weighted average cost tends to be around 0.3%. So it's cheaper than all the industry funds, more transparent than all the industry funds, using purely a rules-based approach that helps you accommodate those risks. Now, as I said, you need to pay for an advisor. If you don't have the skill and experience to do that yourself, you need to pay for an advisor. So you wouldn't do that just for the super itself, but I just wanted to mention it, just because I mentioned all the other options for those people that do have higher super balances. That's a way to sort of cover off on some of those risks. Okay, next question is from Andrew. I feel like I say this all the time, but another really good question. Okay, I'll read it out. Andrew says, thanks for your excellent content. On previous podcasts, you mentioned that ProSolution may reject providing ongoing financial advice for various reasons. You've also mentioned that financial advice may still be useful for complex financial decisions where the next step isn't obvious. And Andrew references episode 354. Since ProSolution only offers ongoing financial advice, do you have any recommendations for financial advisors who offer one-off advice following the same principles as the last chapter of your book, Investopoly? Okay, so it's a really good question, Andrew. And look, hopefully as, the industry, I was going to say improves, I don't really know what the right terminology is. But I think hopefully as the regulatory landscape changes, well, I hope it changes. And then with the use of more technology, AI and so forth, hopefully it starts to become more cost effective to offer one-off advice. But one-off advice is really challenging because you've got to do a lot of work up front to deliver what might seem on the face of it to a client as simplistic advice. And that's just the regulatory environment. It's the piecemeal approach to changing regulations that were literally written in the late 90s when it was a commission-only industry. There was almost no fee for advice. Now it's all fee for advice, of course. So the regulatory environment is completely outdated, and as a result just makes it not attractive to provide that ongoing advice. Also from a job satisfaction perspective, I can say hand on heart that it's a lot more enjoyable working with ongoing clients because you get to learn about their financial situation and you get to build a relationship with them and you get to experience and share that journey together, which gives you a lot of satisfaction. Whereas giving one-off advice, it might seem like that has its own benefits as well, but you never know how it works out. So you don't really know if your advice is any good. Plus also a lot of clients that pay for one-off advice, it just sits on their desk at home and they never do anything with it. So, do you want to, as an advisor, produce all this work that you think is that you pour your heart into, but no one actually follows? Like it's a complete waste of your time and a waste of the client's money. But the reality is, I'm telling you, more than 50% of clients won't implement it. And I say this because we've tried it before. And then the other thing that happens is that clients either don't implement it timely. So, they'll get advice they got 5 years ago and implement it today, but it's not quite right today because their circumstances change, the market's changed or whatever, or they'll only implement a little bit of it because they think, oh, well, I'm just going to do these little bits and not the rest. And that can destroy value as well. So it doesn't, if you're interested in coming to work and doing work that you're proud of and enjoying the outcomes of that work, one-off advice isn't going to achieve that for you as an advisor. So that's the other challenge with it as well. I know that sounds like a me problem, not a you problem, and it certainly is, but that's the reality. Is you want to attract people in your business that genuinely care about what they do and genuinely want to help clients, and those people want to share that experience with those clients, and ongoing advice is the only way that you're going to do that. that. So do I have any recommendations? Unfortunately not, no. There's not many advice businesses out there that do offer kind of piecemeal or one-off advice. I know that there's a guy called James Wrigley, just written a book. He's got a big following on Instagram. I know his business, or the business he works with, First Financial, does sort of some piecemeal advice, so they might be able to help. But that's not a recommendation per se, because I don't know, I know of James, I've never met him, but I don't know that business intimately. But it's really difficult, because the other thing too is, as you would experience from this podcast, is there's a lot of interrelated matters, and you want someone that understands property, understands shares, potentially, I mean, depending on your circumstances, there's not a lot of people out there like that. So look, that's why I put in so much time and effort into the podcast, because I do want to add something to that market in terms of helping people make better financial decisions. I know that I can't help, everyone as a business. So certainly that's my answer to contributing towards that. But look, I do hope it is certainly on our radar to try and come up with a way where we can help people with one-off advice, and particularly maybe people that, might end up growing into, ongoing advice clients, but don't need that full service just yet. We need to, as an industry, find a solution to that. We need to, as a business, and in terms of my business, need to find a solution to that. So it's certainly on the cards. And I think some automation and systemization will help that, which is not saying I'm going to systemize the advice, because that needs to be very bespoke to ensure that it's valuable. But in terms of helping, deal with all the compliance issues, I think that systemization, automation will help there. Great question, Andrew. So thank you for asking it. And it's a really interesting question, because it does impact everyone that listens, really, that isn't ready, or at least the people that aren't ready for ongoing financial advice. And, the reality is we would get a bunch of new inquiries, like people approaching our business every month, and we literally say we can help you to more than 50% of them. So as a business and a business opportunity, that's a terrible outcome, because we would love to help more people. We just, can't do it, partly because of the compliance and cost of delivering advice, and then also the other aspect of coming to work and really enjoying the benefits of the advice that you give to clients. Okay, I'm going to leave it there. Tomorrow, Campbell has a podcast about the revised rules around the $3 million super cap. And whilst you might not necessarily be at 3 million, maybe your parents are, or maybe you might end up having a lot of money inside super in the future. You want to work out how you're going to plan, or whether you need to change any strategies or approaches to accommodate these new rules. Well, Campbell's going to unpack it all for us tomorrow, and I'll be back with you next week. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.